All right, guys, welcome back to another episode of the Black Bullion Show. Boy, do I have a good one for you guys today. We're about to go toe-to-toe with another detractor of gold. In the words of our president, Andrew Jackson, from a couple centuries ago, he said, "I was born for the storm, and a calm does not suit me." Well, funny enough, I'm actually pretty laid back. I'm a pretty laid back guy, but I will defend truth and true money until the end. So, who is throwing dirt on gold's name now? Well, find out shortly, but first, if you're new to this channel, please hit that big red subscribe button right down below. Also, please hit the like button. Helps to get this economic evangelism right on out there to the masses to bring more people into precious metals. Now, I don't even like saying these words that I'm about to read right now, but here's the title. Opinion: gold is a foolish place to put your money right now if you check the facts. All right, guys, let's see what kind of craziness is being written in this article. So let's start. Gold today is nearly as overvalued as it's ever been over the past 5 decades. That's the conclusion reached by just released research from Campbell Harvey, a finance professor at Duke University, Claude Erb, a former commodities portfolio manager at TCW Group, and Tadas Viskanta, founder and editor of the investment blog abnormalreturns.com. Their research couldn't be more timely. In the wake of gold breaking above the $2,000 level, enthusiasm for the yellow metal has reached a fever pitch. Earlier this week, for example, MarketWatch reported that a fund manager forecasted that gold could double to $4,000 an ounce. Before I discuss this new research, let me emphasize that its conclusion has nothing to do with the extreme bullishness that has prevailed for several weeks now among short-term gold timers. That's a bearish omen, as I noted 3 weeks ago, and gold's price nevertheless has continued to jump even higher into all-time high territory. This new research focuses instead on gold's fundamental value in much the same way that Wall Street analysts calculate a stock's fair value. The fundamental justification for a higher gold price that is most often mentioned is inflation. This rationale is repeated so frequently, in fact, that few of us stop to subject it to historical scrutiny. If we did, we would find that it enjoys little statistical support. In fact, the researchers report that a far more powerful predictor of gold's future performance is gold's current price in inflation-adjusted terms. When the inflation-adjusted price is high, gold's subsequent outperformance tends to be low, and vice versa. A corollary of this finding is that gold's price in inflation-adjusted terms is just as volatile as it is in nominal terms. This would not be the case if gold were a good inflation hedge, since if that were true, gold's inflation-adjusted price would be relatively constant. Instead, as you can see from the chart below, gold's price over the past 5 decades is just as volatile in inflation-adjusted terms as it is in nominal terms. So take a look at this graph here, guys. Here is the nominal terms here of gold, and here's the inflation adjusted price. So as you can see here, they're saying that basically in that 1980 spike and that 2011 spike, you know, it was roughly around $2,000 all the same. Okay, now keep that in mind as I continue here. We're almost done. The investment implication is that gold in coming years is likely to be lower than where it is currently. The gold bulls will object that this new research doesn't take into account the extraordinary money creation that the Federal Reserve undertook in March, which they say has no historical parallel. In their paper, the researchers refute this, recalling the similar arguments that were made in 1980 and 2011, the prior two occasions in which gold's inflation-adjusted price was as high as it is now. In 1980, some were concerned about high inflation. From January 1980 to January 1985, the real price of gold fell 65%. In 2011, some were concerned that the U.S. Federal Reserve's policy of quantitative easing will lead to a high rate of inflation. From August 2011 to August 2016, the real price of gold fell about 33%. Currently, some are concerned that the fiscal and monetary policies implemented in the U.S. to counter the economic impact of the Ronies will be inflationary. If gold did not reward inflation fear in 1980 and 2011, why should it reward inflation fear now? All right, guys. When you get into an argument with someone who is clearly wrong, what they often do is take, let's just call it what it is, his argument, a turd, and cover it in roses. But no matter how many roses you place on top of that filth, I'm still gonna smell that filth. Now, what can be hard to figure out when someone does this is tracking where the smell of that filth is coming from within that pile of roses. Well, worry no more. I can tell you exactly where it's coming from. It's called the CP lie. I mean, right. It's the CPI. Now, for those of you who aren't aware of the controversy behind the CPI, allow me to share. So this definition comes from Investopedia. So check this out. Here's a controversy with the CPI. Originally, the CPI was determined by comparing the price of a fixed basket of goods and services spanning two different time periods. In this case, the CPI was a cost of goods index. However, over time, the U.S. Congress embraced the view that the CPI should reflect changes in the cost to maintain a constant standard of living. Consequently, the CPI has evolved into a cost of living index. Over the years, the methodology used to calculate the CPI has undergone numerous revisions. According to the BLS, the changes removed biases that cause the CPI to overstate the inflation rate. The new methodology takes into account changes in the quality of goods and substitution. Substitution, the change in purchases by consumers in response to price changes, changes the relative weighting of the goods in the basket. The overall result tends to be a lower CPI. Remember that, guys, lower CPI is what we have now. However, critics view the methodological changes and the switch from a cost of goods index to a cost of living index as a purposeful manipulation that allows the U.S. government to report a lower CPI. John Williams, a U.S. economist and an analyst of government reporting, prefers a CPI or inflation measure calculated using the original methodology based on a basket of goods having quantities and qualities fixed. Okay. So we had some funny business going on in the, or I should say, after reading that, John Williams actually reading that blurb about John Williams, it sparked me to go down the path of, okay, who is this guy, and what has he offered in regards to understanding inflation? Well, here's this piece on why the CPI is a problem. So he talks about the way it was, and then the latter part he talks about what has happened since then. So here's the way it was. Here's more background on this. Measurement of consumer inflation traditionally reflected measuring the cost of maintaining a constant standard of living, as measured by a fixed basket of goods. Maintaining a constant standard of living, however, is a concept not popular in current economic literature, and certainly not within the thinking or the lexicon of the Bureau of Labor Statistics, the government statistical agency that estimates and reports on consumer inflation. The changing costs of maintaining a constant standard of living were measured by pricing out a fixed basket of goods and services, same components, same weighting, period after period. Whatever the percentage change was in the cost of that basket of goods, That is how much income would have to rise in order for someone to maintain a fixed or constant standard of living over the given period. At least it was a reasonably consistent approximation of same. Tracking changes in the cost of a fixed basket of goods was the approach to estimating inflation, going back to at least the 1700s. And prior to 1945, the fixed basket CPI tracked by the United States government actually was known as the cost of living index. I'm actually going to skip this part here. It actually does talk about how people were considering using a substitution methodology here, but I'm going to skip that. Here we go. Where the substitution-based approach was viewed as impractical for a consumer price index, the fixed basket approach remained the preferred inflation measure. The academic thinking in this area remains divided even today. So some people prefer one over the other. I'm just going to skip to this next section here to give you an idea of where times have changed, or how times have changed. In the early 1990s, political Washington moved to change the nature of the CPI. The contention was that the CPI overstated inflation. It did not allow substitution of less expensive hamburger for more expensive steak. Both sides of the aisle and the financial media touted the benefits of a more accurate CPI, one that would allow the substitution of goods and services. The plan was to reduce cost of living adjustments for government payments to Social Security recipients, etc. The cuts in reported inflation were an effort to reduce the federal deficit without anyone in Congress having to do the politically impossible to vote against Social Security. The changes afoot were publicized, albeit under the cover of academic theories. Few in the public paid any attention, which is why I think we have a lot of people, such as these researchers, who made a key error that I'll bring up shortly. Sam Zuckerman of the San Francisco Examiner noted in the 1990s, for example, Republicans wanted to make changes in calculating inflation along the lines recommended by a special commission, including more use of quality adjustments. By lowering the official inflation rate, such changes promise to reduce the annual cost of living adjustments for Social Security and other federal programs. Take a look here. Catherine Abraham, the Clinton Bureau of Labor Statistics Commissioner, remembers sitting in the Republican House Speaker's Newt Gingrich's office. He said to me, "If you could see your way clear to doing these things, we might have more money for BLS programs." So essentially, he was twisting her arm to change things around. Take a look here. Federal Reserve Chairman Alan Greenspan and Michael Boskin, the chairman of the Council of Economic Advisors, were very clear as to how changing or correcting the CPI calculations would help to reduce the deficit. As described at the time by Robert Hershey of the New York Times, Speaker Newt Gingrich, Republican of Georgia, suggested this week that fixing the CPI index with its implications for lower spending, Social Security, etc., and higher revenue, tax bracket adjustments, would provide maneuvering room for budget negotiators. Alan Greenspan, chairman of the Federal Reserve, is among the other government officials who have spoken optimistically about financial benefits of a more accurate CPI index. Economists believe one of the most important CPI upside biases is when consumers shift their buying patterns in response to changing prices, substituting one product for another. The CPI index is based on a fixed market basket of goods and services. But for example, if the price of an item like steak gets too expensive, consumers may switch to hamburger. The Boskin Commission report, December 4th, 1996, actually used steak and chicken for its substitution example. The examples used in arguing for changing the CPI clearly were tied to prices rising and resulting consumer demand shifting to a lower quality product. Simply put, That was the destruction of the cost of maintaining a constant standard of living issue, and was a primary consideration of those seeking to change the CPI. Although other issues would come into play, the drive here was as to get a lower inflation reading, irrespective of whether the data were more accurate. So, funny business, guys. That was going on in the early to mid 90s. And it led us to changing the methodology of how we arrive at the CPI and the CPI numbers. You know, it has caused for lower percentages, which impacts the first article's point and the researcher's point that the real value of gold during bull market peaks were roughly the same. However, I would challenge that and say, in order to arrive at the real value of gold, you need a real CPI number. Now, I can hear some of you guys saying, well, he didn't necessarily mention the CPI as the inflation measurement for his study. Oh, really now? Check this out. Now, the researcher used the CPI from 1975 and 1920, as you can see right here, January 1975 and June 2020, US CPI, right here, both of them. And here's the US price of gold. And then from there, you can actually calculate and figure out his real price of gold right here. Now, here's the problem. For him to arrive at these conclusions, there were two different methodologies here to arrive at the CPI, completely different. And funny enough, the researcher, actually referred to the Boskin Commission in this same paper. But funny enough, he left out the details such as constant level of satisfaction, substitution of goods, and more. Check this out. This is what he said later on in the research paper. Gold may truly be an inflation hedge, but there is not enough data to prove that gold has been an inflation hedge. There is also the interesting nuance of figuring out which definition of inflation gold is supposed to hedge. For instance, in 1996, the Boskin Commission found that inflation measured by the US CPI had been overstated, and the Commission's report resulted in inflation being redefined. Well, here's my problem with what they are suggesting here. Because right after that, they say, should gold hedge the pre-Boskin Commission report or the post-Boskin Commission report? You know, if neither, then what inflation does gold hedge? That's not, for as far as this research is concerned, you either have the pre-Boskin, the post-Boskin, or you don't believe in either. And when you go back to this actual report here about the real price of gold, you have two different methodologies here, and you're trying to compare the two in order to get a consistent real value of CPI. Yet this number right here was calculated using a different methodology for CPI than this number right here. 1996 was right in the middle. So that either tells me that you either have to lower this for the lowered CPI that we have now, or you have to raise this to account for the higher CPI that was used here. Again, you have to use consistent CPI methodology if you're going to compare these two time periods. So for them to say that the real value of gold has roughly been the same at these different peaks is a complete farce, because they used the CPI numbers from two different methodologies. That's completely, that's a huge error right there. So guys, for me, I just have to let you know, watch out for gold detractors like these. It's almost as if they have something against true money like gold, but at the end of the day, after the methodology for the CPI changed in order to lower it, gold's real value from that first chart should probably be higher, since the CPI should be higher. But let me know what you guys think about all this. You know, as far as the inflation calculation is concerned, what they think about the CPI and what you think the true value of gold is. You know what I think. I think that real value should be way higher than what it is right now because the CPI has changed. But let me know what you guys think in the comment section below. Thanks again for watching. Please hit that like button. Please subscribe if you're new. It's Black Bullion.